Okay, now that I have your attention, I did want to go over some really big news this week. So, in case you didn't know, this Wednesday the Fed is meeting and most likely interest rates are going to go up. But before you get all down and out about it, there is a little bit of a short-term window that by working with a true mortgage professional, we not only study the market interest rates, but also optimizing when to lock in your interest rate. So, let me give a little bit of a long-term view, and then I'll go over my little nugget of what to do this week. So long-term, Fed is reducing their repurchases of mortgage-backed securities. So in case you didn't know, it started off 50 billion a month, and it's gone down from 50 billion to 40 to 30, 20. Now it's 10 billion a month. And then a week from today, it's going to zero. So in case you didn't know kind of why this all occurred since the financial crisis about, a decade ago, the reason why we started purchasing these mortgage-backed securities was to really help drive the interest rates down. Well, these are all great signs that our economy is now thriving, no pun intended. So kind of look at this as although interest rates are going up, we are starting to see the market balance out, which is a good thing because I think we kind of outpriced our first-time home buyer. That's a whole nother different video. So each quarter when the Fed has met, we have seen the yields move higher. Okay, that's just if you go back and look at the data, that's what we can see. Now, it doesn't mean that's the only reason why interest rates have gone up. There have been, and in case you aren't watching my social media, which you should, please, if you're on Instagram, Facebook, YouTube, LinkedIn, go to the Deborah Bird Team. Make sure you like, subscribe so you can get more of these updates. But in case you are on my social media, then you should know that we've had some, the trade worries and the Turkish lira and some of the situations in Italy. All of those things kind of show how the world is interconnected and could also be factors, obviously, to the interest rates. However, where are they right now? Well, we follow the 10-year Treasury bonds, and once we broke the 3.01, which you could Google this, next will be the 3.117, or what we're going to be really watching for is whenever we break to the 3.25, which we will. And why do we know that this is going to be broken? Well, I can just tell you that come October 1st, which again is just a week from today, the Fed is cutting back more and more on these repurchases. It's already, we've seen the trend, but then also kind of the double whammy with all of this is the European Central Bank. They also went from buying 30 billion euros down to 15 billion, and they are cutting back as well. So again, the world is very interconnected, yet at the 3.25%, yields will go up. But in the short term, your little glimmer of hope is that what we have seen is those 25-day averages, whenever we see them move this quickly, it's kind of like when you're walking a dog and the dog quickly runs off. You kind of get that, you pull on that leash. And I follow Barry Habib. So if you aren't familiar with Barry Habib, I highly recommend you watch his stuff as well. He calls this the leash effect. You're going to see kind of a relief this week where prior to October 1st, which again is a week from today, we may see a relief in interest rates. So that means right now, if you are even considering selling, buying, what we've also seen is year over year, although home values have increased 6% on average, home equity has doubled. It's at a 12% year over year. So that means we have a lot of people who, whether their amortization strategy or because of the lower interest rates, they bought down principal, maybe they applied more payments. We have a lot of equity locked up in our homes that I can tell you, I have had conversations with clients that kind of as their debt manager, it's my job to help make sure that whether we use that equity, and sure, you may be locked in at a 3% interest rate and it may go up to 5%. So your payment may go up about, $200 a month, yet we're going to free up a bunch of cash flow monthly by paying off some of that higher interest rate revolving debt. In fact, I just did this for a client a week ago where we increased and they really didn't want to do a cash out refinance. They really liked that lower interest rate. Yet cash flow was a challenge. I will say prior to implementing this strategy, another true professional in my partnership that I have with my financial team, we like to make sure that you are operating and understand how to use a budget, because the last thing we want to do is pull equity out to then just have the same situation occur 5-10 years from now. So we will want to make sure that you are in a healthy budget, but a lot of times we have people in credit card debt, and because of that interest that's charged every single day, we just can't get out of it, because that one $300 payment you may make, essentially like $20 is going towards the principal balance. So one way to maximize the equity in your home is maybe consolidating some debt, relieve some cash flow. We do have a new Investor Advantage program where maybe you want to diversify your portfolio and you want to take some of your equity and buy a rental property. Okay. And another item that I've seen more and more of is some of the renovations, whether they are going to look to sell, and they want to make sure they get top dollar, that they want to do some renovations and they'd like to move up or maybe move down in the home. Now, granted, interest rates are going to be higher when you do this, but you are essentially going to possibly do a debt consolidation strategy where you can now afford that increase in maybe what you're looking for in the home by unlocking some of that equity. So that's just one strategy that I highly recommend you optimize in this short week of when interest rates, again, 1 week from today. Stay tuned for Wednesday. I have a feeling that this is what we're going to hear whenever the Fed meets and releases their policy statement, but chances are the rates are going to go up. They meet again come December. So kind of keep that in the back of your mind that, as we see this unfold each quarter, there is a long-term strategy we could work with on this. And for my real estate agents out there who are watching this, don't forget when we had a big housing boom, what was it, 2004 and 2006, and interest rates were 6.5%. So for those of you who are worried about interest rates moving up, let's not go crazy that rates were at an all-time kind of stupid low to borrow on a mortgage, that even paying 6.5% to own a home that's a fixed loan. I mean, that's less than a lot of these car notes that we see. So don't let that cause you to delay, because like some of my other clients that I'm working with, I have literally nurtured them for about 2.5 years, and they really wanted to buy 2.5 years ago. And the cost of waiting, if you just look at what interest rates were 2 years ago and the price of that exact home that they wanted, by waiting 2 years, what did that cost them? So don't wait is the answer. And if you're looking or needing a cash out refinance and you want to unlock some of that trapped equity and maybe look at some debt management strategies, let my team know. You can apply right away at thedeborahbird.com and we will get you taken care of. But that is my Monday mindset tip for the week. And if you need anything else, just give us a holler. Y'all have a great week.